We live in a digitized economy driven by tech stocks and crypto ledgers, yet humanity remains tethered to an ancient obsession with a physical metal pulled from the dirt. The global economy officially abandoned the gold standard decades ago. Despite that, physical gold is hitting record-high demand and surging prices in 2025. This diagram shows the scale of the physical market. That massive block represents the roughly 200,000 tons of gold currently sitting above ground, dwarfing the 3,670 tons the world manages to produce each year. To understand this modern rush, we have to look past the idea of a single market. Instead, three entirely different types of buyers are competing to hold it. Gold acts as a mirror, reflecting three distinct profiles of wealth, all seeking safety in an uncertain era. The largest slice of global demand, roughly 45 to 50% of the entire market, belongs to the cultural consumer. Nations like India and China drive massive import surges. These spikes track the calendar precisely, peaking during weddings, festivals, and periods of high seasonal demand. In these major Asian economies, gold jewelry functions as a strategic financial reserve, held safely outside the formal banking system. For half the globe, wearing gold provides a form of decentralized generational wealth that ensures family security. The second buyer profile makes up 25 to 30% of global demand, private investors using the metal to hedge their portfolios. This chart compares asset risk against stability. While crypto and stocks offer high volatility, gold occupies a unique position of low risk and high stability. When inflation or economic crises hit, investors move wealth here to preserve its value. When trust in modern financial systems fractures, private wealth retreats to this physical safe haven. Then there are the largest players. Central banks hold the remaining 15 to 20% of global demand, hoarding gold to prepare for geopolitical instability. The United States currently holds the top spot in official global reserves, with approximately 8,133 tons stored in secure vaults. However, the recent price surge is being driven by aggressive buying from rival nations, specifically China and Russia. This shift is part of a de-dollarization trend. Foreign central banks are moving their reserves into physical gold to bypass American financial networks and reduce exposure to U.S. influence. These nations use their gold reserves as a shield against U.S. financial dominance. Meeting this demand requires navigating a slow and difficult logistical network. Extracting gold from the ground is a long-term engineering challenge. Despite massive operations in China, Russia, and Australia, global mine production yields only about 3,670 tons annually, Africa and Asia. To fill the gap, the market relies on a secondary supply of recycled gold, processed through global refining hubs like Switzerland. These price surges are the result of rising economic anxiety meeting the rigid, physical limits of geology. Ultimately, this single physical metal connects the everyday cultural consumer, the private wealth investor, and the sovereign superpower. As long as inflation and geopolitical tensions fracture the global balance of power, the rush for certainty will continue. While paper currencies and digital ledgers depend on political stability and technology, a gold bar remains physically permanent. The high price of gold serves as a direct indicator of global instability. It tracks exactly how much the world is hedging against a breakdown in the modern financial order.